Good morning/afternoon, everyone. I'm excited to dive into today's presentation, which provides a comprehensive overview of the owner's equity cycle and its internal controls. We'll explore the key transactions involved, identify potential risks, discuss essential control activities, and examine how all of these factors impact financial reporting. Let's get started and gain a clear understanding of this crucial area. The owner's equity cycle refers to the series of financial activities that show how ownership interest changes throughout an accounting period. Essentially, it tracks the flow of capital from the owners into the business and any returns back to them. The cycle consists of key components such as investments made by the owners, the accumulation of retained earnings, and any distributions or withdrawals. Understanding this cycle is crucial because it offers a clear view of the company's financial standing from the owner's perspective, ensuring that all changes in equity are properly recorded and reported. This accuracy is vital for both internal decision-making and external reporting. Let's talk about the key transactions in the owner's equity cycle. First, capital contributions made by owners lead to an increase in equity. This means when owners invest more money or assets into the business, the overall equity grows. On the other hand, when owners take money out through withdrawals or draws, it reduces the equity, essentially decreasing the ownership stake in the business. Next, retained earnings play a crucial role. They reflect the accumulated profits or losses over time. Positive retained earnings indicate the business has been profitable, while negative amounts show losses. Lastly, dividend payments to shareholders result in a decrease in equity balances because distributing profits reduces the amount of equity retained in the company. Together, these transactions help us understand how the owner's equity changes throughout the business cycle. When we look at the risks within the owner's equity cycle, there are several key areas to be mindful of. First, unauthorized entries pose a significant risk because they can manipulate equity balances, leading to inaccurate financial statements. Next, misclassification of transactions is another common issue. If transactions are recorded in the wrong accounts, it distorts financial reporting and can mislead stakeholders. Then, errors in recording equity activities can also occur, which might cause account balances to be misstated, affecting the overall accuracy of the financial records. Lastly, the omission of significant owners' equity transactions is a critical concern. Leaving out these transactions can obscure the true financial condition of the company, making it harder to assess its real equity position. Understanding and addressing these risks is essential for maintaining reliable and transparent financial reporting. When we talk about internal control objectives, there are 4 key areas we need to focus on. First is accuracy. It's crucial that all equity transactions are recorded correctly to truly reflect any changes in ownership. This ensures the financial records are reliable. Next, completeness means that every relevant transaction is captured, nothing should be left out, so the records present a full picture. Then, we have authorization controls, which are put in place to prevent any unauthorized equity activities, safeguarding the company from improper actions. Finally, validity ensures that all transactions comply with the established accounting policies, confirming their legitimacy and alignment with regulations. Together, these objectives form a strong foundation for effective equity transaction controls. When we talk about control activities in the owner's equity cycle, there are several key measures that help ensure accuracy and integrity. First, segregation of duties is essential. This means separating who authorizes transactions, who records them, and who has custody of assets. By dividing these responsibilities, we reduce the risk of errors or fraud. Next, formal approval processes are important, especially for equity-related transactions like contributions or dividend declarations. This ensures that all significant actions are properly reviewed and authorized before they happen. Then, regular reconciliations of equity accounts help us catch and correct any discrepancies quickly. Lastly, maintaining thorough documentation standards creates an audit trail, providing clear evidence for every transaction in the equity cycle. Together, these controls create a strong framework that supports reliable financial reporting and protects the company's assets. When it comes to monitoring and reporting mechanisms, there are several key elements to keep in mind. First, periodic reviews play a crucial role. These reviews involve regularly examining owners' equity transactions and account balances to ensure everything is accurate and up to date. Next, detailed audit trails are essential. They allow us to trace every movement of equity, providing transparency and accountability. Management oversight is another important factor. It ensures that policies are followed correctly and helps in quickly identifying any irregularities or issues. Together, all these mechanisms work to verify that our controls are operating effectively, keeping the equity data reliable and trustworthy at all times. When we talk about financial reporting and auditing, having robust internal controls over the owner's equity cycle is absolutely essential. These controls help ensure that financial reports are accurate and complete, truly reflecting the ownership interests of the company. For auditors, strong internal controls provide the foundation to gain reasonable assurance that equity-related accounts are free from material misstatements. This not only supports the auditing process but also enhances confidence among stakeholders. When people trust the integrity of the financial statements, it strengthens the overall reputation and credibility of the organization. Moreover, effective controls significantly reduce the risk of errors in equity reporting, which can otherwise lead to costly mistakes or misinterpretations. Finally, robust controls play a crucial role in preventing fraud, safeguarding both the company's assets and its reputation. So, in essence, strong internal controls are a fundamental part of reliable financial reporting and maintaining trust in the business.